Market structure is ultimately going to give us the direction and general narrative that we are going to need in order to build high probability trading ideas. So it's imperative that we understand the general concepts of market structure and then how they link to supply and demand. So let's jump into market structure. We'll start with a bullish market structure or an uptrend. And when we're looking at a bull trend, what we see is a series of higher highs and higher lows as the market pushes to the upside. Basically, when we're looking at a healthy uptrend, we'll see a push to the upside followed by a retrace or correction, which is shown by price pulling back and then price moving back to the upside, breaking the previous high and then continuing on to make a higher high. Price then retraces or corrects back to the downside and then moves back to the upside, breaking the previous higher high, creating a new higher high. And this will continue to happen over and over again until a trend is exhausted and either begins to range or switch to a downtrend. Now, of course, this example is more of a utopian example. And what that means is this is the textbook picture perfect bull trend. But we also know that if we've looked at any price charts and tried to compare what we see in textbooks to what we see on the charts, we know those are two very different things. So what we have here is a more real life example of an uptrend. What we can see is we're still making higher highs and higher lows, but there's a little bit more noise or fluctuation in between the two ranges. So between the higher low and the higher high. And what we can see here is price begins to correct. And what happens is the correction ends up creating substructure. And what substructure is essentially a trend within the overall range, because price right now in its current state is caught between this swing low and this swing high, and anything in between is what we would call a complex pullback, which means that price is pulling back, that we have no real confirmation that price is going to continue higher or lower. But as we're looking at a bull trend and we know what happens after we create a higher high, the market wants to pull it in a higher low. And as long as we don't invalidate the previous higher low, we would still be in an uptrend. So as long as this low doesn't get broken, we would still be in an uptrend. And it's a complex pullback because we could initially think that maybe this was the higher low, but then we put this one in. We might think that's a higher low. Then we might see this one and might think that that's a higher low. But until we actually break this higher high, we don't actually know. Now what you'll see is price then begins to pull to the upside. We get another correction and then we finally break that higher high. When it comes to mapping out market structure, and this is something that you'll need to test a little bit on your own personal preference, is I'm sure looking at it, some of you are wondering why we chose this as the higher low and not this as the higher low. And the reason is because this is the origin of the move that broke that structure. Now, of course, when we're looking at a supply and demand framework, we might be more interested in demand zones that came from this point. But when we're looking at an actual market structural range, this would be the range in question that we would be looking at. And then again, what we can see is once we put in this higher high, we've created a complex pullback, a little less complex than this pullback, and then we've moved to the upside. But this definitely showcases a more realistic market profile that we'll see in a bullish trending market as opposed to this. Now, we may see some frameworks of this more clean ebb and flow from higher high to higher low, but more realistically what we're going to see is more complex pullbacks and substructure between our ranges of higher highs and higher lows before we actually break to the upside, of course, if we're going to see a bull trend continue. Now on the flip side, if we look on the right side of the chart, we can see that we have a downtrend or bearish market. And what this is classified as is the market making series of lower lows and lower highs. And we see that in succession. And as long as price is continuously breaking lows, creating lower lows and creating lower highs, we are said to be in a downtrend. What we can see, again, similar to this example, is we create a low, we pull back, so we move back to the upside as a retracement or a correction, and then we move to the downside, breaking the previous lower low, putting in a new lower low. Again, once we've facilitated that lower low, we then create a retracement or a correction, and then we followed by a break of that previous lower low to create a new lower low. Again, a retracement or correction followed by a new lower low. And this will continue until price either enters some sort of range or switches from bearish to bullish. But again, like the bullish example, this is more of the utopian example. This is the textbook example. But we want to also look at what we're more than likely going to see on a true price chart so that we can be prepared for what is to come on an actual chart. So what we can see here is we have price creating a lower low. We get that retracement or correction to create a lower high. We then break that previous low, creating a lower low. And what we can see in between this lower low and this lower high is a bit of substructure where we are creating what looks to be a lower high, but then we end up breaking the previous lower high, creating a higher high of this substructure until we finally create this lower high. But this lower high is not yet confirmed until this lowest low is broken. So anything that's basically in the middle of this range until this lower low is broken, confirming a new lower low, or if price breaks to the upside and starts to trend bullish, creating a higher high, all of this price action is just caught within the range and hasn't actually proved any structural relevance, except for the fact that it is substructure, and on a lower time frame we can also look at the structure in that regard. But again, if we haven't broken the lower low, we haven't actually broken out of that range, we have not actually created a lower high as of yet, and unless we break the previous lower high, we haven't switched trend or invalidated the bearish market structure. And then what we can see is price again creates a down move. We create another lower high within this, but we haven't actually broken structure, and then we then move and break structure to the downside, creating a lower low. Again, similar to the bullish example, I have marked out the lower high as the highest point within this range. But again, what we might interest ourselves in when we're looking at supply and demand zones is this area to see if this has any relevance, because our new operating range would be this as we create this lower high before we create a move to the downside, creating the lower low. So again, what we're looking for when we're mapping out our market structure, if we're in an uptrend, we're creating higher highs and higher lows, higher highs and higher lows. And what we're expecting once price creates a higher high is a pullback, a correction, or a retracement, whichever way you want to describe it. And what we'd be expecting is for price to then break that previous high, creating a higher high. But if price does not break that higher high, we're caught between this range of price. If we break to the upside, that's a higher high, which is confirming more of a bull trend. But if we then break to the downside, we have then invalidated the bull trend and could potentially be switching bearish. And on the flip side, again, if we're looking for a bear trend, we're looking for lower lows and lower highs to be created. And then once we are waiting for our next lower low to be created, we're trading within this price range. Price could very likely move into this sort of complex pullback and then create the lowest low, and that would still be a valid bear trend. Or price could then move to the upside, which then would invalidate the bear trend and potentially be switching bullish. Market structure is incredibly important in deriving our overall narrative in terms of how we should be viewing the charts and how we should be mapping out our supply and demand zones. For instance, if we are looking on higher time frame market structure suggesting bullish order flow, what we should be doing is looking for demand zones to be looking to buy for longer term trades. Of course, we can take short-term sells into those higher time frame demand areas, but ultimately, if we're looking for higher time frame and longer term longevity, we want to be trading with the trend. The trend is your friend until it ends, but that is why we stay on top of mapping out our overall market structure and understanding what's happening. Then what we must do is combine this with supply and demand to get our edge and to truly understand what's happening and what's creating this market structure. Now let's take it one step further and just combine market structure with supply and demand to understand how they interact with one another. Using the same examples from prior, what we can see is we have the, again, utopian bullish trend example. We're creating higher highs, higher lows, higher highs, higher lows, higher highs, and higher lows. But if we take that a step further and look at that in the lens of supply and demand, what we can see is when we create that pullback, we are creating what would be a supply zone, whether it be a pivot supply or a range created supply. And what we can see is price also creates a demand zone. The demand zone is ultimately what is respected, and that's what creates a supply zone failure, which then creates the highest high. And again, when price retraces or pulls back, we create another supply zone. And what ends up happening is price will come back into a demand zone, which in this case is the higher low area. And as long as we don't break below this higher low, we're still in an uptrend. And what we can see is price respects demand and continues to moving to the upside, failing supply and creating a higher high. Again, when price pulls back, it taps into demand, it respects demand and breaks supply. And this is ultimately what we are combining when we're combining market structure and supply and demand. It's the inner workings and the relationship between supply and demand, and how demand being respected and supply failing creates a bull trend or an uptrending market. Or if we're seeing supply being respected and demand failing, we're seeing a downtrend. Now, again, we'll look at this real life example because this is more of the textbook example of market structure. But similarly, what we can see is we have a supply zone that's created. We put in our higher low. Price breaks to the upside, breaking the previous higher high, which creates a supply zone failure. We get our complex pullback. And another point that we can add on that's a little bit more advanced, but something that I touched on in the supply and demand section. When we're looking at the complex pullback, what you'll often find are supply zones in this case that are created and that price is respecting within the overall complex pullback. But again, what we're looking for is price within this range. If we're breaking to the upside, we'd be creating a higher high, which continues our uptrend. Or if we break to the downside, we invalidate our bull trend. But what we can see is we respect supply. So what this does is it absorbs all of the supply so that when price respects this demand zone, price has nothing to slow it down in this point in time. And what we can see conceptually, and this is something that's quite common when we look on live charts, is price respects this demand zone, moves to the upside. We tap into the previous supply zone. It doesn't immediately fail, but instead you do get a reaction. And how I said in the previous supply and demand zone videos that more often than not, supply and demand zones will have a reaction, but it's the follow through that's the most important. And what we can see is this newly created demand zone from the initial reaction to the upside is respected, and price moves to the upside, breaking supply, making supply fail, creating a higher high. And then what we see is price then create a new supply zone as it creates a pullback or a retracement. We tap back into the newly created demand zone. Demand is respected and price continues moving to the upside, creating a higher high. And this is the relationship in a bull trend between supply and demand and market structure, that we're seeing demand being respected and supply failing. We might see supply get reactions initially, but ultimately this is when we start looking at our demand zones and asking ourselves, are these going to hold? And if so, should I be expecting a higher high? And now what we'll do on the flip side, we'll discuss the downtrend or bearish market structure. And what we can see when we're looking at the bearish market structure, we can see the price creates a lower low. Price then retraces, creating a lower high. The process that creates the lower low creates a demand zone. And when price moves to the downside, breaking the previous lower low, which causes demand to fail, creates a new supply zone. So when price creates a lower low and begins to retrace or correct, price then creates a demand zone. It taps into the supply zone, which respects it, and then price rapidly moves to the downside, breaking the previous lower low, creating a new lower low, again breaking demand here, and then price corrects, tapping into the newly created supply zone, and then creates a new lower low, which then causes demand to fail. And what this is doing is showing that supply is being respected as demand is continuously failing, which is then creating our lower lows and our lower highs. Our lower lows are being created by demand failing, and our lower highs are being created by supply being respected. Now we'll look at the real life example just to add a little bit more context, because of course the textbook example does not translate well to a price chart. So what we can see is, again, we create this lower low and a lower high on the correction. We have our demand zone. Price breaks to the downside. We create that lower low. We've seen a demand zone failure. So what we'd be seeing is price is operating between this range and price. Price then begins to correct or move to the upside. And what we're doing now is we're waiting for a lower high to be printed. Again, a lower high is only confirmed once we break the lower low that has been printed. So what we can see is price creates a lower high, or what we think is a lower high, and then moves to the upside. And what we would see again is a demand zone being created within this substructure, respects the demand zone, which pushes it to the previous supply zone, which we see a reaction from, which moves price down. We then see a reaction of the demand zone, price moves back to the upside, taps into a newly created supply zone, and then that's where we see price react, creating a lower low. And again, this would be our higher low within the range, but we would be looking and more interested in these points for supply zone for future use. And again, we see price create a lower low, which caused this demand failure. We'd be waiting for a correction or retracement to form. Again, taps into the supply zone, moves to the downside, creating another new lower low, causing this demand zone to fail. And this is the process that happens over and over again, where we see supply being respected and demand failing. We see price creating lower lows and lower highs. And this is the key connection between market structure and supply and demand. And the more that we can understand this concept, the better we can get at deriving a narrative on the higher time frame as well as on the lower time frame, because what we'll now be digging into is the multi-time frame fractal nature of market structure and how we can use that market structure to get a better understanding of what's happening on the higher time frame and what's happening on the lower time frame and how they both relate with one another.